Today I want to talk with you about how to design the right financial tool that helps you accomplish the purpose of privatized banking. Now, before we proceed, I want to make sure we're on the same page with privatized banking. We're talking about how do I take over the banking component in my life in a way that allows me to store capital that I can use for emergencies and opportunities, that I can have safety, liquidity, and growth. Meaning it's not going to drop in value, and I can access and use this money. I can get to it when I want it. And it's growing. It has uninterrupted compound growth, meaning when I use the money, it doesn't stop growing. So I borrow against it, using it as collateral instead of taking out my own capital so that it can continue to grow. And then how do I also make sure that that rate of return is competitive and I'm keeping up at least with inflation and my dollars are doing as much as possible for me? And again, this is just while they're being stored. This is not even talking about when I'm putting those dollars to work in an opportunity or an investment vehicle that is producing income and cash flow, because then I can actually get returns in two places at the same time. And those are some of the main benefits and advantages of privatized banking. So what tool allows us to accomplish this? Now, the ideal tool that we've discovered to help you accomplish those purposes is specially designed whole life insurance. People react and say, I don't like whole life insurance. And the reason is that they've heard that it's expensive and that it takes forever to build cash value. But I want to help you see it a different way. Within designing a life insurance product, there's already enough options to choose from, even just with a typical design. But within each product, there's also many different levers and adjustments that can be made to really supercharge this vehicle and maximize its purpose and maximize its usefulness to you. Now, many people do not know all of these adjustments and calibrations, and they're not aware of how to make this really as efficient as possible for you. So I want to help you understand that. Now, when we're looking at a whole life insurance contract, there's three parts. You have your premium, which is what you're putting into the policy. You could think of it as a deposit if we're thinking of a bank account. Then you have your death benefit, which is the benefit that pays out when you die. There's also a component called cash value, and it's like the equity inside the policy. It's what you can access and use. Now, when we're looking at privatized banking, we want to maximize the cash value, but we don't want to give up the long-term growth of this asset. So you can think of it like a teeter-totter in an old-fashioned playground, maybe when you're a kid. On one side, we have early high cash value. We have access to a lot of capital up front. On the other side, we have long-term growth, the highest long-term growth that you can get. And what happens is often there's a trade-off and one or the other is really in play and we sacrifice and give up the other. So when people design a typical whole life insurance policy, they will have high death benefit and a high long-term growth, but they give up the early cash value. There's also another way to design it that you have a lot of high early cash value, but you give up the long-term growth. What we want to do is make sure that you're maximizing both and finding that fulcrum point, that tipping point that's ideal for you so that you can maximize the usefulness and the utility of the policy in your life. So how do we do this? Well, one of the main levers is the premium ratio, the type of premium that you put into the policy. There's two main types that I want to share with you today, and these are just some of the features and the design structure and elements that you can change within a policy. The first type of premium is called base premium. Now, what this does is it builds up a lot of death benefit and a lot of long-term growth. Many of the typical whole life insurance policies have all base premium, and that means that they're going to have a high death benefit, but they're going to have access to only a little bit of cash value up front. Now, there's another type of premium called a paid-up additions rider, and the name varies a little bit from company to company, but generally it's called a PUA or paid-up additions rider. When you add this type of premium into the policy, this builds high early cash value. Here's an easier way to think about it. Base premium is kind of like a mortgage payment. If your death benefit is the value of the house, which is a large value, your mortgage payment is a small contribution towards that overall home value. What's happening is over time, you're putting in those small incremental mortgage payments, which is your base premium payments, and over time you're building that cash value, which is going to finally equal your death benefit, and you're going to be able to build that equity inside of a house. Now, the paid up additions rider is different. That's like buying a small rental property outright. So what happens here is that this death benefit is a small amount of death benefit, but you're fully paying for it, meaning for that portion of death benefit, no more premium is due. It's like you're paying fully for that small rental property. The property value is smaller, but the amount of equity that you've built up is almost equal to the property value, if not equal, right away up front, because you've already made the full payment. So over here with the base premium, you're making a small payment for a large death benefit over time, and you're buying that death benefit. Over here with the paid up additions rider, you've already bought that death benefit, and you are having the full amount of equity available. Now, here's why the balance point is essential. We want to have the most high early cash value, but also the most long-term growth. So we want base premium and paid up additions. We don't want just one or the other, or we're going to sacrifice something. Now, while the ratios may be different from person to person based on their age, their gender, and their habits, and what they're trying to accomplish, the ideal point that we've found in most cases is 33% base and 66% paid up additions rider. That does give us a little bit of flexibility to design the policy differently and add on additional riders that may be needed to supercharge and maximize the policy. So I hope this sheds some light for you on why design is really important, because you can't just use any old life insurance product, and you really can't even just use any old cash value life insurance product. It needs to be something with guarantees and the special design to make sure that you're able to use it the way that you want to accelerate time and money freedom. Hey, I hope you liked this video. If you did, click the link in the description box below for more information. And don't forget to like this video. Share your comments, questions, and feedback in the comments section below. And don't forget to hit subscribe to our YouTube channel.